A common term you might hear in fund investing is a market cycle. As dimensional fund advisors Wes Crill has written, many investors inform their sentiment about markets by looking for cycles in returns. He warns, however, that, quote, rolling returns give a false sense of cyclicality because of overlap among consecutive periods. He adds, investors should avoid basing market expectations on this illusion of predictability. With us today to discuss why chasing cycle returns is more myth than science is Mr. Crill himself, who serves as a vice president and head of investment strategist at Dimensional Fund Advisors. Hi, Wes. Thanks for joining again to talk about cyclical investing.
Yeah. Hey, Murray. Thank you for having me on today.
You betcha. You've also written multi-year returns expressed over overlapping periods often appear cyclical, implying prior returns are useful indicators of future returns. However, this is one cycle investors may want to avoid riding. Rolling performance simply obscures the volatility in stock returns that is impeding predictability. Now, I think I understand that, but could you explain how the concept of rolling returns and how this can be used to seem like it's something that it really isn't?
Yeah, of course. I mean, we can kind of break it down from the start, which is why people are looking for these sort of signals anyway. Human beings often joke that we're pre-programmed, we're pre-wired to look for patterns. And if you could find signals in the marketplace that would predict what the market was going to hold in the future, it would be very lucrative. So there's a lot of incentive to do this. Professor Ken French describes it the best when he talks about the evolutionary tendency we have to look for patterns, where if you had, two people back in ancient human history who both thought there might be something in the bushes, it looked like a tiger, the one that completely dismissed this pattern probably didn't live long enough to procreate, whereas the one who interpreted, I'm not sure if that tiger is there, but I'm going to take off running, they're more likely to have their genes continue on. So certainly investors are always looking for this. There are many sources of data in which we do see cyclicality, so something that does appear to follow a pattern. A lot of economic data when we're looking at GDP growth, inflation, unemployment, things like that. And the reason why they take on cyclicality in the data is because they're slow-moving variables. So there's a strong autocorrelation, which means that the value of these variables in one period predicts a lot of the value in future periods. There's a strong correlation as you go through time. You really can't see that in stock data. Stock price changes are far too rapid to have that level of autocorrelation. Autocorrelation is almost non-existent within stock returns. And so the idea that you would end up seeing cyclicality doesn't make a ton of sense. The reason why people will often believe they're seeing cyclicality is because we spend a lot of time looking at rolling returns. It's a way to kind of see, okay, what has been the investor experience over 1, 3, and 5 year periods. And a lot of times, if you wanted to assess that historically, you would look at rolling periods. So this month, I look at the last 3 years. Next month, I look at the last 3 years again. When you do that, let's say I have consecutive 3 year periods. If I'm measuring them in consecutive months, they're overlapping 35 out of the 36 months. So you're going to get strong autocorrelation simply because you have a ton of overlap in these. That is not a useful observation for investors. It doesn't help you understand anything more about what's to come. It just tells you that when I form another overlapping period, it's probably going to have a lot of correlation with what I just came out of. So, and this is something we delved into in the work. You can see when I look at 1, 3, and 5 year periods, they're not overlapping. They have basically zero autocorrelation, which tells you that there's no benefit to looking at prior returns if I'm trying to predict what's coming down the pipeline, unless I have that overlap. And even randomly generated returns, if I just pull returns out of a hat and then simulate a 1, 3, and 5 year period, if I overlap them, then I get this same effect. So it really is about looking at the wrong measure and trying to find patterns that don't truly exist in the data.
So cycles, if you focus on cycles, you're really statistically mucking up the whole statistical process of figuring out what's going on in the stock market, right?
That's right. Yeah. And if you think about it just from a formal statistical standpoint, if I'm trying to get an idea of the probability of something happening, well, you don't get a good, what I'll call forward-looking or ex-ante probability estimate from overlapping data because they're not independent observations. You need independent observations to get an idea of what the distribution of outcomes is like. But when you look at these rolling returns, you'll start to see something that's not there. And again, to the extent that you interpret, say, what you believe is a predictor of weak market performance, if you were to decrease your exposure to the market at the wrong time, I mean, we saw a lot of this just going back to Q1 of 2020, where many investors, because they were concerned about where the market was going, not necessarily because of cycles, but if they were pessimistic about the direction of the market, a lot of people went into cash in March of 2020. The next 6 months, you have a really strong global equity market return. And so trying to time markets, no matter what your basis or indicator is always fraught with peril, because market returns can show up unexpectedly, and you don't want to miss those because it can really derail your long-term prospects.
And is that true for bonds as well as stocks?
You can see it a little bit more in terms of autocorrelation in bond returns, mainly because a big driver of bond returns is the yield. And yields generally are not going to be moving around as much as stocks. But even then, when you look at predictions for the future, you get a lot of information about bond returns just looking at current market prices. But to the extent that you can predict changes in the overall yield curve based on anything that is backward looking, that's again something that is not held up well to any statistical test. So people really haven't been able to nail those predictions about changes in interest rates. Now, the idea that you can actually predict what future bond returns are going to be to a much higher extent than in equities, I think is part and parcel of the differences in risk and return between those asset classes, right? That's why fixed income is potentially offering a lower rate of return, because the level of uncertainty about that future return is much lower than in equities.
And that's what Dimensional's process is all about in terms of bonds, correct?
Exactly. I mean, we look at fixed income the same way we would in equities. We see half a century of data that suggests that trying to time markets or pick individual securities has not been consistently successful. So we do just like we do in equities. We look at prices, basically how much we're paying, what do we expect to receive. And that works just as well in fixed income as it does in equities to identify these systematic differences in expected returns, and you can position a portfolio to capture those.
Okay. Thank you for your time again, Wes.
Yeah, thanks for having me.